And when it comes to savings, we hear the word annuities a lot. But what does that mean? What is an annuity? Here to talk to us about the financial term from Wilsey Asset Management is President and CEO Brent Wilsey. Brent, good to see you. Good morning.
Good to be here. Good to explain this.
Okay, yeah, it is. I was telling you about, about Mr. Fisher, who says he will never sell you an annuity.
Yeah,
very well-known investor.
Right, exactly. And it's very funny because you get in the mail, you get this thing like, wow, free steak dinner at, Brigantine or Carver's restaurant. Like, wow, let's go to that. They're not going to sell me anything. These salespeople are so good, they will sell you. And that's why they do it. They give you this free dinner because they're going to sell you. We'll talk more about the big commissions more towards the end. But I want to explain annuities to people so they understand, because when you go to these annuity salespeople, they're not explaining all the aspects. I mean, you got three different types. You got the fixed annuity. What that means, like a CD, you get a fixed interest rate for a certain time frame. You also have a variable annuity. Now, what that means, you can put your money into mutual funds that are wrapped by the annuity blanket. Now, this is terrible because of the fact your fees on annuity, these variable annuities, are many times 2 to 2.5%, and that's just enormous. It takes away from your return. One that people like are the indexed annuities. They say, oh, well, those are guaranteed. I'll never lose any money, but I'll get the upside. But there's what they call a cap rate. What that means, they'll cap your rate a certain percent, maybe 8, maybe 10%. So, okay, so I only get 10%. Some years, the returns could be 20, 24% that you're missing out. And yes, you have no downside, but your average return over 10 years is less than had you just invested into the index directly.
Okay, back to the steak dinner.
You want one of those, don't you?
No, is that a situation where they invite you and you have to sit down and listen to their pitch?
Exactly.
Okay,
yes, that's what that
now
is. It's a sales technique to get you at the restaurant, and then they get you in there, and they're going to talk about how bad things are. Oh, we got war in the Middle East, and the Red Sea, and the market, and they go on and on how bad things are. But you can be safe with annuities. But they don't talk about the other things too. What insurance company are they using? You want to understand, well, where's my money going? Because I want to make sure it's a strong insurance company, like a bank. You want to go to a strong bank. Well, there's rating agencies like Fitch, Moody's Investments, Standard & Poor's. You want to check the rating of this insurance company because you don't want to be investing your money into a weak insurance company because you could have problems down the road.
So annuities are directly related to insurance companies? Is that
yes,
what you mean?
They are. Yeah, that's what. Yeah. Because insurance companies do life insurance, and annuities are the two major products that they do. And the other thing too I want to point out is that they also have what they call annuitized. And this is another one. Oh, you get a 7% rate. Like, wow, that is fantastic. But that is a rate that you get on a distribution on the end. Your principal is gone. You're getting a 7% distribution rate. So if you want your money back in 5, 10 years, it's gone. It's not there any longer. And I do worry, I don't want to get too technical here, but I worry about mortality, the return on investments, because we talk about the insurance company, the ratings. You can look to see, well, where they invest in their money. Do they have a lot in commercial real estate? Do they have a lot in, bonds that are going bad? Are they in equities? So while you may think you have a good product here, many times you got to look at the strength of it. And we've had insurance companies back in, I think it was the 80s, 90s. Baldwin United went bankrupt, and people took them years to get their money. And I do worry about this going forward. We do have some problems in our economy long term. Short term are fine, but what about 10 years, 15 years down the road? You've given your money to this company for your life. That's just a dangerous situation.
So where's a better place to put the money?
You want to invest the money. And again, you're going to have the volatility. We've talked many times in here about investing into real estate, into equities, good quality equities that pay dividends. And by the way, these index annuities, you don't get the dividends. They keep those. And I want to also point out before I forget too, that people say, well, they're insured. I'm safe. Well, they're insured by a company called the Insurance Guarantee Association, which is backed by the insurance companies. And I've seen people put $1 million in annuities thinking they're insured. They're only insured up to $300,000 for all your annuities. Like if you do a bank, the FDIC insures $250,000 in each bank. Well, the insurance is $300,000 for all your annuities, and it's very hard to find this information. FDIC, very easy to find. And I don't feel comfortable with things backed by the state. I don't know about you.
Yeah, I get you there. All right, Brent Wilsey Asset Management. Thanks, Brent.
Yeah, and I'm pointing out the big commissions. They have big commissions and long surrender charges.
That's right.
Yep.
All right, stay away from those.
Yep.
Okay, thanks, man.